When you sell a put option on Nvidia, you can have three consequences. Number one, you do not buy Nvidia shares because the stock's price does not fall to or below the strike price you chose. You keep the option premium, and that is a profit. You win. Number two, Nvidia's price falls to the strike price or below it, and you buy the stock at a price cheaper than Nvidia's current market price. Again, you win. You also keep the option premium, which makes it a double win. Number three, Nvidia's price falls drastically below the strike price and to a level that the option premium does not cover. You begin to lose money. Although this is a softer loss, a smaller loss than buying Nvidia shares outright from the market would have caused, it is still a loss. In this video, I will show you how to deal with the third consequence so that you can stop losing or at least minimize the number of losses while selling Nvidia put options. In this image, I have today's Nvidia chart on TradingView with a 2-hour time frame. I have used two indicators to help me make a trading decision. They are UT-Bot and Detrended Price Oscillator, DPO. UT-Bot has a key value of 3 and an ATR value of 10. DPO has a length of 21. For candle patterns, I have chosen regular candles, but you could use Heiken Ashi for a clearer chart. For example, this chart. This chart shows you have 3 buy signals and 2 sell signals within the last 50 days. Since we are selling put options, we are interested in the buy signals only. We will wait for the buy signal to appear and the first green candle to end green. At the same time, we want to see the DPO line above or crossing above the 0 line. Once these two conditions are fulfilled, we will go to Nvidia's option chain and sell a put option at a strike price at or below the ATR line. In this case, the current stock price is $114, and our put option strike price is $105. We will exit the market when our put option is in 50% profit or when we see a sell signal and a complete red candle. If you have a higher risk appetite, you may turn to a 4-hour time frame and continue holding the option until there appears a sell signal on that time frame. If you have a lower risk tolerance, you may turn to the hourly chart and exit the market by buying your put option back when you see a sell signal. In addition, you may continue to hold your options if you see a sell signal, but the DPO line remains above the 0 line. Why do we wait for the buy signal? If we sell the put option and the stock falls further, the option will be more expensive for us to buy back or exit from. If the stock rises, the option will lose value faster because it will move away from the put option's intrinsic value. That means we do not need to hold the option until the expiry to exit the position. In simple language, we want the stock price to rise after we sell put options. Once we exit the position, we can sell a new put contract with a different strike price and expiry date, thus earning a second premium from Nvidia. As you can see, you could trade put options on Nvidia 3 times within the last 50 days, and all 3 times you would have won your trades. This is Nvidia's option chain. I have chosen December 30th as the expiration date, but I don't intend to hold my position until expiration. I take a relatively longer expiration because that gives me more premium, and also gives the Nvidia stock to recover if it temporarily underperforms for a day or two. According to this option chain, the nearest strike price is $140, but I would choose $130 or $32 as my strike price. I would earn a premium of $660 or $706 per option contract. To be able to sell this put option, you need to have a buying power of at least $13,200 in your account, including margin. However, if you don't have a buying power as high as that, you may trade NVDX, which is T-Rex 2-time long Nvidia daily target ETF. As you can imagine, this ETF rises or falls 2 times of Nvidia's performance daily. NVDX's chart is similar to Nvidia's chart. This is Nvidia. This is NVDX. This is NVDX's option chain of December 20th. Here, the nearest strike price is $18, but I would sell put options at $17 for a premium of $200 per contract. To be able to trade an NVDX contract of put option, you need to have a buying power of only $1,700 in your account, including margin. This is much more affordable than trading Nvidia options. And since it is more volatile than Nvidia, as it is a leveraged product, you gain comparatively more premium by selling put options. As this image shows, imposing the 2 indicators, UT-bot and detrended price oscillator, offers the same buy and sell signals on the NVDX chart. Like Nvidia, you could also use the hourly time frame on this chart. Trading NVDX also gives you the flexibility of closing a part of your trade to lock in some profit to let the rest of the trade run risk-free. For example, you could sell 3 put option contracts with a buying power of $5,100 and close 2 contracts at 50% profit and let the third contract run for more profit.